We've always been told a very simple story. Debt is the fuel of the economy. It gives people homes, allows companies to grow, and helps nations develop. But when you take a closer look at history, you realize that debt has never been just a financial tool. Debt has quietly moved in the shadows where power and control are most subtle, invisible to the eye, yet its impact has always been at the very center of our lives. Debt, in its simplest form, is a promise. You borrow today and agree to pay back tomorrow. But hidden within this simple promise is power, the hidden mechanism of interest. Interest turns the future into profit. For thousands of years, societies struggled to understand this idea. The ancient Mesopotamians recorded debts on clay tablets, but they also periodically wiped them clean through debt forgiveness, because leaders knew that when too many people were trapped in debt, the system collapses. In the Hebrew Bible, debt forgiveness was commanded every 50 years. The logic was simple: debt was dangerous. If left unchecked, it could enslave entire populations. Yet over the centuries, elites learned not to erase debt, but to weaponize it. In medieval Europe, the Catholic Church officially banned usury, the charging of excessive interest, but merchants and bankers found ways around it. They disguised loans as trade agreements and created complex financial instruments that didn't even look like loans. By the Renaissance, powerful banking families like the Medici in Florence built empires not on land or armies, but on lending. They financed kings, popes, and merchants, gaining not just money but political leverage. Debt was becoming more than a financial product. It was the engine of power. The real transformation came in the 17th century with the rise of state debt. When the Dutch Republic fought for independence from Spain, it raised funds by selling bonds to its own citizens. Investors could buy government debt, earn interest, and trade those bonds like property. Suddenly, war was no longer limited by the gold in a king's treasury. The future could be sold to fund the present. The Dutch perfected this model, and soon England followed. The founding of the Bank of England in 1694 formalized national debt as a permanent institution. Governments no longer borrowed only in emergencies. They lived on debt, rolling it over indefinitely. Bankers who managed this debt became indispensable to the crown. Debt had graduated from private contracts to the foundation of state power. The profits were enormous. Lending to governments was considered the safest investment because governments could raise taxes to pay back creditors. Wars that would have bankrupted kings could now be financed indefinitely. And those wars, in turn, expanded empires, opened new markets, and created more opportunities for debt. It was a perfect cycle. The more nations fought, the more they borrowed. The more they borrowed, the richer their creditors became. By the 18th and 19th centuries, the bond markets in London, Paris, and Amsterdam were the beating heart of global finance. Armies marched, ships sailed, colonies were conquered, all on borrowed money. But this wasn't just about nations. As industrial capitalism spread, ordinary people were drawn into the cycle. Railways, factories, and infrastructure projects were built on credit, financed through bonds and bank loans. Workers earned wages from companies funded by debt, and then they themselves borrowed to buy homes, tools, and consumer goods. Debt seeped into every layer of economic life. By the 20th century, debt was no longer a tool solely for governments or tycoons. It had become an everyday product sold to the masses. Mortgages, car loans, credit cards, student loans. The entire architecture of modern life normalized borrowing as the default condition of existence. And here's the hidden genius or hidden cruelty of it all. Debt doesn't just generate profit once. Every interest payment is a transfer of wealth from debtor to creditor, from the many to the few, repeated month after month, year after year. Unlike a product you buy once and use, Debt is designed to be permanent, to lock you into a cycle of payments that never truly ends. A 30-year mortgage will cost 2 or 3 times the sticker price of a house. Credit card balance carried month to month can grow faster than your ability to pay. What began as a promise becomes a trap. Debt then is not just a financial arrangement. It is the most successful business model in history. No factory, no warehouse, no raw materials are required. Generates wealth out of time itself. And the ones who understood this first, the merchants of Amsterdam, the bankers of London, the financiers of Wall Street, became the architects of the modern financial system. This system doesn't just manage debt. It manufactures it, expands it, and depends on it to survive. By the mid-20th century, debt had stopped being a tool used only in emergencies and had become the lifeblood of the global financial system. The Bretton Woods Agreements of 1944 institutionalized this reality. The IMF and the World Bank were founded to lend money to nations in crisis or development. But behind the lofty rhetoric was a simple mechanism: debt as discipline. Countries could borrow, but only on terms dictated by creditors. The IMF, dominated by the US and Europe, began attaching structural adjustment conditions to its loans. Entire national economies were told what to cut, what to privatize, and how to reorder their budgets. Debt wasn't just profitable. It became a lever of political control. At the same time, a quieter revolution was happening in the daily lives of ordinary citizens. In the decades after World War II, banks discovered a way to sell debt not just to governments and corporations, but directly to households. The mortgage became the crown jewel of middle-class aspiration. Owning a home, once reserved for elites, became possible for millions, but only by signing a contract chaining families to 30 years of payments. Car loans, furniture installments, and eventually credit cards transformed debt into a consumer product marketed like any other. The psychological shift was massive. Debt was no longer shameful or rare. It became the normal way to participate in prosperity. Buy now, pay later. Enjoy life today and let the future take care of itself. For banks, this was a goldmine. Interest from millions of households produced steady, compounding profits. For governments, it created the illusion of endless growth, as consumer demand could be fueled by credit, even when wages stagnated. For corporations, it guaranteed a steady stream of customers who could be enticed into spending money they didn't yet have. Debt became the hidden engine of modern capitalism. And unlike selling physical goods, selling credit was infinitely scalable. You didn't need to dig a mine or build a factory. You just needed signatures, contracts, and the authority to create money out of promises. The danger, of course, was that the entire system became addicted to expansion. Banks didn't want debts to be repaid quickly. They wanted them rolled over, refinanced, extended. Governments learned that borrowing was easier than raising taxes. Central banks, with the power to create money, made it all possible. Debt was no longer a temporary bridge. It became the permanent architecture of the financial system. By the 1970s and 1980s, the consequences of this addiction were impossible to ignore. Developing countries across Latin America, Africa, and Asia had borrowed heavily, encouraged by Western banks eager to recycle petrodollars after oil shocks. When interest rates rose sharply under Federal Reserve Chairman Paul Volcker, these nations suddenly found themselves unable to service their loans. The debt crisis exploded in 1982 when Mexico announced it could not pay. The solution? More loans, under harsher terms, managed by the IMF and World Bank. Debt became a trap. You borrowed to survive, then borrowed again to repay, losing more control with each cycle. Meanwhile, ordinary citizens faced austerity, inflation, and unemployment. Elites and creditors collected interest. In the developed world, the financial industry discovered new ways to package and sell debt itself. Mortgages, car loans, and corporate bonds were bundled into securities traded globally. Debt was no longer just a contract between borrower and lender. It became a commodity. Wall Street shifted focus from producing goods to engineering debt instruments. This process, called financialization, turned credit into the most important raw material of the modern age. Profits were staggering. Banks originated a loan, sold it to investors, collected fees, and moved to the next one. Risk was supposedly spread, but in reality it was only hidden, waiting for the next crisis. The 2008 financial collapse was the logical outcome. Trillions in mortgage-backed securities, built on the premise that homeowners would never default en masse, imploded. Debt had been stretched beyond reality, and when it snapped, the entire global system trembled. Government stepped in, not to punish the sellers, but to rescue them. Ordinary families lost homes, jobs, and savings. Banks received bailouts, and after the dust settled, debt didn't shrink. It grew. Central banks slashed interest rates to zero and flooded the system with liquidity. Cheap credit encouraged governments, corporations, and households to borrow even more. Global debt today exceeds $300 trillion, more than 3 times the world's annual economic output. Never in history has humanity owed so much to so few. The irony is that this mountain of obligations is celebrated as growth. Politicians point to rising GDP while quietly knowing that much of it is borrowed from the future. Debt has become such a normal part of life that most of us barely even think about it. A young person fresh out of school takes on tens of thousands in student loans, promised as an investment in their future. Couples sign up for 30-year mortgages, sold to them as the ultimate dream. Governments keep running deficits year after year, and most voters barely blink, because the real consequences are hidden, happening quietly in the background, and yet, the profitability of debt has never been higher. Banks earn interest on every loan, but they also create entire industries around servicing debt, refinancing, collection, restructuring. Investors make fortunes buying and selling sovereign bonds, betting on the creditworthiness of entire nations. Hedge funds speculate on distressed debt, profiting from bankrupt countries or struggling corporations. Credit rating agencies, supposedly neutral referees, become gatekeepers deciding who can borrow cheaply and who must pay a premium. Debt is not just a financial product. It is a marketplace in itself, where promises are priced, traded, and exploited. The most striking feature of this system is how it concentrates wealth. Every interest payment funnels money upward, from millions of households paying credit cards and mortgages, to the balance sheets of the largest banks and investment funds. Debt doesn't just generate profit, it reshapes society, locking in inequality. Those with assets can borrow cheaply to buy more, leveraging wealth into greater wealth. Those without assets borrow expensively, trapped in cycles of repayment. Debt becomes a mirror of class division, polished and legitimized by the financial system. And now, as central banks explore central bank digital currencies, the next evolution of debt is already on the horizon. Imagine programmable money, traceable and controllable at the code level. Loans could be automatically approved or denied based on algorithms. Interest rates could be adjusted in real time, penalties enforced instantly. To many, this sounds like efficiency, but if the history of debt teaches anything, it is that efficiency for the creditor means less freedom for the debtor. The most profitable product in history is being upgraded for the digital age, and once again, it will be designed far from the public eye. So what is the lesson here? Debt is not neutral. It is not just a tool for progress nor a natural feature of modern life. Debt has been deliberately cultivated as the most profitable product ever created, a product that turns time itself into money, transforming individual hopes and the struggles of nations into streams of interest payments flowing upward. Understanding debt is key to realizing that financial freedom cannot be handed to you by the system, because the system thrives on keeping you indebted. Real wealth means minimizing dependence on borrowing, questioning the promises of easy credit, and recognizing that behind every loan offer is a machine designed to profit from your future. History does not repeat exactly, but patterns are always there. From the clay tablets of Mesopotamia to suburban mortgages, from Dutch bond markets to Wall Street derivatives, the story is the same. Debt enriches the creditor, burdens the debtor, and reshapes the world in favor of those who control the flow of money. And the cruelest trick of all is that we're taught to celebrate it, to call it progress, to mistake borrowing for prosperity. If this has given you a new perspective, hit subscribe. History holds the answers. You just need to know where to look.